An investor purchases stock for $29 and a put for $0.2 with a strike price of 27.5. The investor also sells a call with the same expiration date for zero point 0.2 with a strike price of 30. At expiration of the calculate the maximum profit and loss and the break-even price. Calculate the profit or loss when the price is okay.
So my first question to you is before you're gonna begin doing things, just by reading the first three lines, what did you get? Which strategy it is?
It is a it's a combination of it's a protective put plus he's short a call.
Sorry?
So that's almost like he's bounded his returns. Like it's like is it what is straddle? No wait.
You're almost there, almost there. So
It's
you found it right that he's a long stock and a
sorry, it's
long
a
put.
caller.
Absolutely, absolutely. This is a collar.
Yeah.
This is a collar because you are
But
truncating your upside and you're saving your
yeah,
downside, right? Because you are also
yeah.
selling a call.
Right, right.
So when you're selling a
Protective put
call,
plus covered call. Got it.
perfect, perfect.
Yeah, got it.
Uh,
Um,
I'm just
so just
thinking one more thing
yeah.
with a strike price. Oh, okay. There's another interesting thing that you can see over here. Did you notice one more thing in this question?
Uh,
I'll tell you.
yeah.
Did you notice what is the put price?
It's point two, point
What
two,
is it? What is the call price?
point two.
Exactly. So what does that mean? That you can actually offset your overall cost.
Yeah,
When you buy a
yeah,
put, you pay. When you sell a call, you get. And when the
yeah.
price is same, effectively you offset the whole transaction. And
Hmm.
this way, this is not just a collar, but a zero cost collar. Again,
You
zero
see,
cost collar is no terminology as such, just in
huh,
case. But you should know if the question terminology as in it's not a jargon, but
huh.
it's a valid name that it's a zero cost collar.
Got
It
it.
means it means that you are somehow truncating your profits and you're saving your downside at no
Hmm.
cost.
Mm-hmm.
Right? Okay.
Got it.
Now let's just start calculating the maximum profit and loss and break even.
Yeah. So maximum profit is bought it for 29. So it was 30. So maximum profit is like $1. So that's essentially 30 minus 29. The the cost of the put is offset by the sale of the call. So it's maximum profit is $1. Maximum loss is 29 minus the 27.5, which is 1.5.
Perfect. And what's the break even?
Break even is 29.
Perfect. Okay. Okay. All right. So just by looking at this, you don't have to do part B. I understand that
Yeah,
you would be able to do it.
yeah.
Let's just look at three.
Version 3. The
Yeah.
euro is trading at USD 1.035. A trader expects the euro to become much more volatile than is reflected in current option prices. Puts and calls on the euro are available. Puts with a strike of 0.98 are trading at USD 0.005 and with a strike of USD 1.04 are trading at USD 0.17. Calls with a strike of USD 0.98 are trading at USD 0.0 with a strike of trading in compute at expiry break-even price or prices of the correct option strategy. So since it's volatility, this is a straddle strategy. So
Okay. Very good.
you buy a put and buy a call of the same strike price.
And which is
Um, right?
yes. And which is in this case.
Just a sec. Yeah, I'm not sure on this one. Which one? So
So,
this is currently trading at 1.035. One set is like above the current trading price, and one is below the current trading price.
right. All right.
And
So a few takeaways from this question. So one thing is, Gaurav, you will see a lot of questions with a lot of information,
hmm, hmm,
right?
hmm.
One good way to handle such kind of questions is that when there's so much of information, keep writing on the paper,
Okay.
right? So if I have to solve this question,
Hmm.
I would say that okay, euro is trading at USD. One second.
1.05. Oh,
So when I say that USD is one, euro is trading at USD 1.035. So just write USD 1.035. This is better. Okay. And then it says euro to become much more volatile. So by this I know that the volatility is going to increase.
hmm.
Okay. So I would know for volatility what all do I have? I have straddle,
Yeah.
but when the volatility is going to increase, I would long straddle.
Hmm. Hmm. Hmm.
Next is they say that puts and calls on euro are available. Puts at a strike price of 0.98. So basically, I have got put, I have got call,
Hmm.
and I have got for 0. Strike price 0.98. It is trading at 0.005 and 1.04 trading at 0.017.
Yeah.
Similarly, you have a call. Did I put call? I put okay. For a call 0.98, basically it's the same thing 0.98
Yeah.
and 1.04. It's
Yeah.
just that the values are 0.068 and 1.04. Sorry, for 0.004. Now, it says compute the at expiry break-even price and price of the correct option strategy. So when they say correct option strategy, we know as a
It's a
fact that
straddle.
correct option strategy is straddle, right?
Yeah.
Now
Yeah.
think
Yeah.
about this. When the price is 1.035 and the
Yeah.
volatility is going to increase. So do you remember when the volatility increase, we try to buy at the money,
Hmm.
call and put,
Yeah.
right? But for a at the money call and put, it has to be 1.035, which we
Yes.
don't have.
Yeah.
But what closest that we have is 1.04,
Yes. Yes.
right? So what we can do is I can buy, but again, just to ensure this, we are not really trying to create here spreads, which means that there is no way that I'm trying to save my cost, that I
Yeah.
would buy at a lower this or higher this or something. The
Acha.
idea of a straddle is that we try to buy both call and put at the ATM. So
Got
I'm
it.
going to choose the same strike price for this, and I will be paying overall 1.017
Yeah.
plus 0.004.
Yeah.
Right? So ultimately, when the stock price is this much, it should at least increase by this for me to break even. The
If
sum
the
of this,
stock. Yeah. Yeah. Correct. Correct.
my stock price should increase by a sum of this for me to
Correct.
break even.
Yeah.
And if it doesn't move, then this is my loss.
Hmm. So
Make sense?
basically, it can move on either side, right? Like it can be like the stock price can fall of that much amount or increase of that much amount. It'll make
Absolutely,
sense.
absolutely. Because
Yeah.
we are buying put and call together.
Yeah. Yeah.
I'm okay with either side. This will
Yeah.
also give me profit. This will also give me profit.
Got it.
Okay. Understood?
Yeah.
Problem with CFA is that they give you lengthy paragraphs,
Mm-hmm.
right? And then if you read all at one go, at the end of the last line, you will understand कि अरे बहुत complicated. I don't know where to start.
Yeah.
Right? So let's just break this down into small parts and then see क्या कर सकते हैं.
Yeah.
All right. So I think so far we have covered our law call, we have covered put, we also covered caller,
Yeah.
we also covered bull spread.
Sorry, what is the
What?
bull spread?
No, we haven't covered it. Sorry. One second. I'm just looking at what all we have covered so far.
Yeah.
Oh, we covered call, we covered
Yep.
protective put,
Yep.
and then caller, and then straddle.
Yes.
Right? All right. Let's begin today for a new thing which is called as spreads.
Uh-huh.
The name itself says that I am trying to earn something in between,
Hmm.
right? Think about this. I bought something at 100 rupees. Not really, I bought, but I just asked somebody that will you sell me at 100? And then I already have a party as in a person, a third party, who is ready to pay at 105.
Okay.
Right? Think about this. So effectively, I didn't put my money. I took 105 from him, and I paid 100 to the first party, keeping
Mm-hmm.
5 rupees in between.
Hmm.
Right? So effectively, I just earned the spread without
Right.
investing any money.
Okay. Okay.
Right? So when I say spread, it means that you are not really going to buy something as stock, but you will play around with options to get the spread. Now, what
Hmm.
does that mean? There are two strategies in this. One is a bull spread. Another one is bear spread.
Okay.
One thing to understand here is, although we explicitly say that if it is a long spread or sorry, if it is a call spread or a put spread, but the assumption goes by this that if I'm calling it as a bull spread, it inherently means that I'm looking at bull call spread.
Okay.
Although obviously there is a product that is called as bull put spread,
Hmm.
but if I'm just saying bull spread, it is assumed that I'm looking at bull call spread.
Hmm.
Basically, I am going to earn some spread from playing around with calls,
Got it.
right? As I said, there will always be a product. I'm going to talk about this later. But in the exam, when you look at tell me a strategy or do something on the strategy which is bull spread, assume it's a bull call spread.
Hmm.
Now that we have understood that there is something called as bull call spread or bull spread, what exactly does it do? And I said spread means that you're trying to earn something in between.
Hmm.
Acha, how about the strike price? Let's say the current stock price. I don't own it. For
Hmm.
the same NBCC stock,
Yep.
the current stock price is 100.
Okay.
Now, I assume that the price is going to increase,
Okay.
but obviously, I am not going to buy the stock. However, what I can do is I can put some money in a call option,
Mm-hmm.
let's say for a strike price of 105.
Hmm.
Now, obviously, when the price increase over and above 105, I'll start earning and my potential is unlimited upside.
Yeah.
But again, I'm very smart. I don't want all the money of the world. I want to save my costs and earn some money,
Hmm.
right? How about me selling a call at a strike price of 108
Okay.
for rupees, let's say 2.
Okay. Okay.
So this way, my effective premium that I paid would be how much?
1.
Absolutely. Right? And obviously, when I'm going to earn, I would not earn anything before 105, and I will not earn anything post 108. Do you agree?
You want to, yeah, correct.
I won't earn anything less than 105.
Yeah,
Look at this one.
correct.
And this is 105. And
Right,
I won't earn anything after 108.
right.
But have you seen this curve before?
Yeah, it's very much like a collar.
Absolutely. Isn't it very similar to column?
Yeah,
Where we are long a stock, but plus we are long a put and
yeah,
we sold a call.
yeah,
Payouts are similar. But
yeah.
then think about this, we invested a lot over there. We bought
Correct,
the stock,
correct.
bought the put, and then we just saved some of the cost by selling a call. But
Hmm.
look at this, I got the same payoff by just investing some money in the premium. That too, I have covered it by selling the call at a higher price.
Hmm.
Right? So again, the payoffs are similar, but why I'm calling it as a spread? Because I effectively did not buy any stock or something. I just played around with the spread.
Got it.
Hence the name spread. And why bull spread? Because I am looking at something when the market is on an uptrend.
Okay, got it.
Right? We know there's a normal jargon in the last Street that it's a bullish market or a bearish market,
Yeah,
right? So bullish market says that the market is going to go up, and since we know that our call options and we are long call, so we are
yeah,
betting on a situation where the price is going to go up. Hence the
yeah,
name bull.
yeah,
And since we are earning on the spread, hence the name spread.
yeah,
Pretty clear?
yeah, clear.
Let's look at another situation. When I think that the price is going to go down, so current price is again 100. How about that I buy a put for a strike price of 80?
Okay.
Obviously, let's say at the rate of 5 rupees. And then, since you paid this money, so to save some cost, let's just sell a put at a strike price of 50 at the rate 2.5.
Hmm.
Right?
Yeah,
How does we usually create? We say that okay, this is how our look like, that
yeah,
before 80 we
yeah.
don't earn anything, but less than 80
Very good.
we
Yeah.
start earning, right? But in this case, since we have already sold the put, effectively my profits would now be truncated.
Hmm.
My profits would be truncated, and I would only be able to earn this much, which is 80 minus 50,
Hmm. Hmm. Hmm.
right? So effectively I will be earning 30 rupees just in case the price goes down to zero. Assume the price goes down to zero, we
Yeah,
will earn 30 rupees,
correct.
right? And we paid how much?
We,
5,
yeah, 2
and
point.
we received 2.5.
Yeah.
So in a nutshell, can we say that for a bull spread, and for a bear spread. For a bull spread, what's my maximum loss? We're just
Uh,
talking about loss, profit, and break even.
yes, maximum loss is basically the premium you've paid to buy the call minus the premium you've received to sell the call, and usually you buy like um,
Can I say that is going to be a net premium paid?
yeah, correct.
Obviously, it can never be negative.
Yeah, correct,
Negative
correct.
as in there cannot be a possibility
Yes,
that I can pay less and I can get more. No way.
yes, yes.
Right? So it is going to be net premium. If nothing works out, I don't own the stock. Nothing works out, I'm just
Yeah,
gonna have a loss of the net premium.
yeah.
Right? What's my break even?
You break even is again net premium paid.
For a stock price, that's 100, and
Okay,
you bought for 105, and
okay,
you sold. I'm calling it as a plus, and selling it for 108.
okay, okay.
So how much money do you need to break even? What's your break even price?
105 is it?
But 105 plus the premium paid,
Yeah, 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 yeah. Correct.
right? Because when I say
Yeah.
break even, it is it. When I say break
What
even
is the
means
price? Got it.
exactly what is the price?
Got it. Got
What
it.
is the price? So whatever is the lower strike price is
Hmm.
the lower strike price. Okay.
Hmm. 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 Hmm.
So lower strike price plus the premium paid.
Hmm.
Are we good?
Yeah.
Okay. And how about the maximum profit?
Um. That is 3 minus premium paid, net premium paid.
I agree. And when you say
Uh,
three, it means can I say
One.
it's the higher strike price
Yeah.
minus the lower strike price
Yeah.
minus a premium paid.
Yeah.
Right?
Yeah.
All right. If you're okay with this, let's just quickly recap on beer split then. What would be my maximum profit, maximum loss, and break even?
Yeah. Your
What's my loss?
maximum. Yeah. Loss would be net premium paid. Break even would be break even would be 80 minus premium paid.
Can I say it is the higher strike price
Yeah. Yeah.
minus the premium paid
Yeah. Yeah.
profit?
Maximum profit will be higher strike price minus lower strike price minus premium paid.
Perfect. Okay. So you got these very well, right?
Yeah.
Now, although it is highly doubtful that you're gonna get a question on bull put spread,
Bull put spread. Yeah. Yeah.
you're highly unlikely.
Yeah.
But I'm trying to say that it is easy to understand that if my payoff diagram for a bull spread, which is bull call spread, is something like this,
Hmm.
then obviously my bull put spread is going to be something like
Okay. Okay. Bull put spread. Okay.
this. Because
But is
ultimately,
this is this is this not the same as a? Oh yeah. This is bull put spread. Sorry.
yeah, this is reverse of a bull call spread or a bull spread.
And we didn't do bear yet. Bear
No,
spread.
we did right. So when I said bear spread, I meant bear put spread,
Yeah. But
which
isn't
is
the bear put spread the same as the bull put spread?
so for a yeah, bilkul, totally.
Oh, okay. Okay.
In a bear put spread, we were something like this, and then we truncated, right? Yeah,
Yes, yes, yes.
totally.
Okay.
The payouts would be similar, right? But then it's
Yeah.
very highly unlikely that you're going to get a question on this one, so it's
Oh,
fine.
yeah.
Now, one thing that I want to talk about is there's another topic in your syllabus that talks about adding a short leg to long position,
Okay.
right? So what I'm trying to say is that what we usually do is that when we, let's say, buy options, right, we tend to first either, let's say, you have a strike price of x1 or something,
Hmm.
right, and you have x2 of another price which is higher.
Hmm.
So what I'm saying is, when I say that uh, let's just buy of a stock price 100, let's just buy a call at a strike price of 105, and let's
Yeah.
just sell a call at a strike price of 108.
Yeah.
So we did everything right away, isn't it?
Yeah.
And I'm saying, and obviously every option has an expiration.
Yeah.
So in most of our transaction, we assume that we would be closing out the transaction plus minus at the same time because we are buying at the same time. So the
Hmm.
expiration date will be at the same time,
Hmm. 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 Hmm.
right? But
Yes.
what I'm saying is, it's not always the case,
Okay.
right? So I'm saying that maybe you just in a normal scenario, in a normal, let's say, bull spread itself, and this is generic obviously, but I'm saying, let's say, in a bull spread, you bought a call for a strike price of 105, right? And then you waited for a month. Let's say it's a 3 months
Hmm.
expiry, and then you said, and then you saw that the price volatility is too high and the price has already reached 110.
Okay.
Had it been a normal scenario where you would have bought a strike price of 108, your option would have executed from the
Yeah.
buyer because you're selling a call, right?
Yeah.
But I'm saying it's not always necessary that you buy options at the same time. What you can do is you can buy, basically, you can sell. You can sell a call at a later date
Mm-hmm.
for obviously a longer time. So when I say, let's say
Hmm.
you do the transition in January and
Hmm.
this has expiration till March 31st,
Hmm.
you probably sell a call in February till
Hmm.
April. So basically, they say that adding a short leg to the long position, it means that the net transaction will be short because you have a longer short period,
Yeah.
and then the long, and not necessarily that if this is for 3 months, you will always have for this as 3 months only. You might have
Yeah.
it for 4 months, right? So the point that they are trying to make is that there is no specific rule on how these things should be planned. Rather, it is more about the market conditions.
Hmm.
So there is no rule that you will always have to buy at the same time,
Got it.
right? Also, the other way around. I just want to talk about other way around as well. That let's say he is 105, and if he thinks that the price is not going to go any more further,
Yeah.
if he believes that the price is not going to go any further, and if he sells the call at a strike price of 106, then he can earn a lot of premium, right? 107,
Yeah.
let's say, if the price is at 106,
Yeah.
and if he sells a call for 107, he can earn even more,
Yeah.
right? So I'm saying, depending upon the view of the trader, there's no rule that everything has to be bought at the same time. Depending upon the situation, he or she can always change the strategy. You are
Hmm.
still you are still a bull spread because you are buying a call and you are selling a call.
Yeah.
You're still a bull spread, but not at the same time.
Yeah.
Make sense?
Makes sense.
All right. Since we are sure with this, Let's just try one question to understand if we are 100% okay, and then we'll proceed. Let's just try the second one.
Yeah. As an investor, purchase a put for $4 with strike of 25 and sells a put for $1.8 with a price of $20, strike of $20. At expiry, compute the maximum profit and loss and the break even. So this is basically a bear put spread. And the maximum profit and loss and break even. Maximum profit is higher strike price 25 minus lower strike price minus net premium paid, which is 4 minus 1.8, which is 2.3. So 5 minus 2.3, this is like 3.7. No, 2.7.
Okay.
That's your maximum profit. Maximum loss is basically 2.3. And break-even price is 25 minus 2.3, which is 22.7. Pardon?
Investor buys put for 4, strike price is 25, so as a put for this, strike price of 20, okay. Compute the maximum.
So it's 2.2 is the
What
net
the net premium pay?
2.2?
2.2, right?
Yeah, not
Yeah,
2.3.
okay.
2.2.
Okay, agreed. Yeah.
So everything is basically 2.2 is net premium paid. Your maximum profit is basically 25 minus 20 minus 2.2.
Correct.
Right. Your maximum loss is 2.2, which is the net premium paid, and your break even is 25 minus 2.2,
Perfect.
22.8.
Great. Okay, let's just try one more, the third one. No, don't do part B. It's easy that
Yeah.
you would do it. Let's just try
A
part.
stock, a stock trades at 30.51. A stock. Actually, let's just do part B. No, one sec. Let me just see.
Okay, let's just do it.
Yeah. Calculate the profit or loss when the price is $15. So at
I'm saying,
15.
I'm saying take 5 minutes. Aram se just do it, and then we'll see.
Yeah. Yeah. So at $15, you will make your maximum profit of $2.8.
Okay.
At 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 20, you will also make maximum profit of $2.8. At 23.5, you'll make a loss of negative 0.7.
Okay.
At $25, you'll make your max loss of negative 2.2, and the same for $30.
$30. Okay. Okay. Are you feeling comfortable now?
Yeah, fully comfortable.
Let's just try question 3. It's a pretty
Yeah.
interesting question. Let's just discuss one.
The stock trades at 51. Calls with strike price of 47 and 53 are priced at 5.25 and 0.75 respectively. Compute the initial investment for a bear spread. For a bear spread and break-even price or prices of the spread at the options expiration. Calls with a strike price of 47 and 53. Bear spread. This is interesting. So compute the initial investment. So bear means underlying you believe that the market will go down. right? That's your fundamental belief. So if you believe that the market will go down, you believe that it'll trade below 51. So you don't believe that it'll go up. So effectively, you will want to play with the, you would want to sell the 53. You get a premium of 0.75, and then what do you do with the 47? Stock is at 47, you believe it will go down. You know for a fact that it will go down. You want to pocket the spread. Yeah, stuck a bit.
So there are too many information in this one with the small
Huh.
words. It says the stock trades at 51, which is fine. Calls with a strike price of 47. So one is below the stock price
Yeah,
and 53 is above the stock price, and they are
yeah,
being traded at 5.25 and 0.75 respectively. Compute the initial investment for a beer spread. The problem, if they wouldn't have mentioned this word, we would have taken it differently on how should we deal about this.
yeah.
But when it comes to bear spread, where our strategy of a bear spread is that we we buy at a higher strike price and we sell at a lower strike price, isn't it?
Buy at a higher strike price
Think of
and
a situation where the stock price is 100
yeah,
and we buy at 70 and we sell at 30. Yeah.
correct.
So the strategy remains the same. This is what I'm saying. If they wouldn't have mentioned bear spread,
Huh.
we would have handled it differently. But since they said it's a bear spread only,
Yeah.
so we go by the normal nomenclature that we buy at a higher strike price and we
Okay.
sell at a lower strike price.
Okay.
Is that
Okay.
okay?
Yeah.
If that's okay, then if you are actually buying at a higher strike price, sorry, yeah, if you're buying at a higher strike price, how much are you paying?
You are paying 0.75.
Correct. And if you are selling at a lower strike price, how
You
much are
are
you getting?
5.25.
Exactly. So this is actually a inflow if you look at it,
Yeah. Yeah.
right?
And basically the belief is that at 51, the call guy won't execute his the guy who buys the call at 47 won't execute because he's not met his break even yet.
I actually sold, sorry, I actually bought at 53, right? And sold 47. Yeah. So what we're saying, come again?
No, because you're selling an in the money call,
Mhm.
the idea is that the guy who has the call won't execute the call because he's not yet met his break even price.
क्यों नहीं? देखो, let me tell you this. Okay, there's a conceptual problem here. So the point is that always remember this. This is no exception to this. The moment your option is in the money,
Yeah,
it is assumed
you will execute.
you will execute. 100%, no doubt about this. Now,
Yeah.
whether I'll, अच्छा, think about this. अगर वो 47 पे he would have executed and assumed that he would have paid 5.25, at least he have at 51 he has covered his 4 rupees. Why
Yes.
wouldn't he? I agree with you that he hasn't reached his break even. Doesn't mean that he's not going to execute.
No, makes sense. Otherwise, he'll lose everything instead of.
Exactly. So he will immediately execute at 47.
So just in terms of what happens is I sell, like I'm talking about the bear spread, I sell a call for 47, right? I gain 5.25, and suppose the strike price, I mean, the current price is 51. I have
Correct.
lost 4, right? So I've
You have
gained
lost. Oh, okay. Good.
5.25. I have to pay 0.75, and I
Uh,
have lost 4, right? So I've effectively gained zero point 0.5.
okay, tell me something. How have you lost 4?
Because you sold a call option
That's fine, huh?
and the
Now
guy
look
has
at this.
executed.
Okay, let him execute. How much money? Think about this. How much money have you got? 5.25 minus 0.75.
Yeah,
How much it
yeah,
is? 4.5.
yeah,
So you got 4.5 rupees in your pocket
yeah.
and you're done. You don't own a stock. You don't make a loss. The option was in the money.
No, no,
Let him
wait.
execute.
But suppose take all of this out. I sell a call.
You sell a call, okay?
I get the premium, and then like
The pricing, the price increases.
I've sold a in the money call. Then I don't lose anything. That's what
You
you're
will
saying.
lose. No, no, you will lose. That's a naked call, right? That's an uncovered
Yeah,
call. So if you're saying that leave everything aside, you are just selling a call which is in the money call.
yeah. But isn't that what I'm doing here also? I've sold a call which is in the money. The call that I bought, it doesn't do anything. Like I don't
No,
execute it because the price is 51. So I'm effectively like I have a shot on a call and someone will execute on me. So I'll lose money, right? Is that not like that's what's gonna happen?
yeah, let's just see. One second. Let's consider a situation where you're only selling a call. All right.
Yeah.
The stock price is 51.
Yeah.
Strike price is 47. Right? Current stock price is 51. Strike price
Yeah.
is 47. And the premium is 5 rupees.
Yeah.
When you sold a call, you earned 5 rupees.
Yeah.
And this is, since it is in the money, the maximum profit is 5.
Yeah.
The maximum loss is unlimited.
Yeah. Yeah.
That's why it is called as a naked call or an uncovered call.
Yeah.
So it's not something that you're not making a loss. Obviously, you are making a loss,
Yeah.
right? So this is what we have discussed.
Yeah. So you're saying that by buying the call at 53, I've protected my downside in this entire.
Abhi, now. Let's just add another layer to it. So I'm saying that I buy a call at 53.
Yeah.
What's my maximum profit in this case?
Is 5 minus the.
And also, let's just talk about that. How about if the price at expiration is 51, as we just discussed, and let's talk about 55,
Yeah. 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 So
right?
at 51, what will happen is you won't execute the call that you bought at 53, right?
Correct.
So you will earn the 5 rupees because you sold the call option. 5 rupees minus the premium you paid to buy the call at 53, which is zero point 0.5, so 4.5. And the thing is over here, it'll be minus 4.
What is minus 4?
The loss you've made on the call option.
Okay, let's talk about the my maximum loss. Right?
Your
This is my
maximum.
maximum. This is my profit. You agreed?
Yeah, this is your profit, correct? Maximum profit.
At loss at 51. Let's say
Yeah.
it doesn't move at all, and that's the max it goes at ST, which is at expiration. The maximum price is 51 only,
No.
right?
This is where I'm a bit confused because at 51 at expiration at 51, the guy who you sold the call to will execute it.
Correct.
And he will execute at 47, current price 51. He will pocket 4 and you will lose 4.
Correct. So in this case, you will effectively buy from the market.
Yeah.
At 51.
Yeah, and sell it to him at
and sell
47.
at 47, making a loss of 4 rupees.
Yeah.
And he will buy at 47 from you and will sell it in the market at 51, making a profit of 4.
Yeah. So basically over here,
so your loss in this case is 4 rupees.
Yeah. So your payoff is 0.5.
Yeah. So effectively, your payoff in this case, if at expiration it is 51, it is 0.5. Yes.
Yeah.
Totally.
And now to come to maximum loss, so that would be
if there is no 53. If there is no 53, the maximum loss is infinity. You understand that?
Yes, that I understood.
Let's talk about if it is 53 and at the expiration the price is 55.
55. Okay.
That's what it is.
So what you would have at 55. So the guy executes. You've pocketed 4.5 already up front. Guy executes from 47. It goes to 55. So 8. He's got 8. You've lost 8. But then you've gained from the call option that you have. So that's a gain of 2. 6. Is it 2.5? The loss.
So let's do.
Yeah.
These are random numbers I have to do. So we agreed that we earned 4.5 initially.
Yeah.
Till 53, he will earn. So I'm looking at from my angle that I earned 4.5. 4.5 positive. Then effectively from 47 till 53 is how much?
That's about 6.
6, right? So I have to pay 6 effectively, right?
Yeah, so your maximum loss is, okay, correct, 1.5, yeah.
And then I don't have to use this one because it effectively offsets.
Yes, correct.
Right? So that's what my payoff would be.
Got it. Perfect. Understood.
Because after this, it will offset my profit and my loss.
It will always offset, yeah.
Make sense?
Makes sense.
Okay. So in this one, the only catch was that even though we looked at this and it was looking foolish to sell at 47 and buy at 43, yet the strategy was bear spread, hence we had to do it. Right? So that's something that you need to keep in mind.
Yeah.
All right, let's just talk about. So they are basically they called as Greeks, right? I hope you know a few of them at least.
Yes.
And then there are 4: delta, gamma, theta, and then vega. Let's cover one by one. What's a delta?
How the price of the derivative changes with the price of the underlying.
Okay. So can I say if stock price moves from 50 to 51, right? How much my option price would change is being determined by data. To keep it simple, right? Ultimately, the idea is, and think about this is very realistic, and gamma is not so realistic to be honest, but at least theta, vega, and delta are very much realistic. And the reason being that you say that let's say the stock price is 50 right now, right? And then you have a strike price of 51 with a
Yeah.
call premium of, let's say, 7.5. And then you have a strike price of 52, and then you have a call premium of 5.
Okay.
So I want to understand, right, that if I move one unit more, 50 to 51 or 51 to 52, how much my option price is changing. And let me tell you, the relation is not linear,
Hmm. Hmm. Hmm.
right? Which means I cannot say that 51, 7.5, 52, 5, then it is for 53, it's 2.5. That's not the case,
Hmm. 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 Hmm.
right? But the idea is that delta gives us that flexibility to calculate theoretically that, okay, this could be the approximate price. Although what you see in the market, the actual thing, or when you calculate from a model, it is not going to be same because there are so many factors.
Got it.
Every moment the volatility is changing.
Yeah.
Every day or every hour the theta is passing, the time,
Hmm. Hmm.
right? And then depending upon what the price is and what the strike price is, the option could be in the money, out of the money, or at the money, which
Yeah.
means the gamma is also changing,
Hmm.
right? But then it at least gives us a good approximation of how our option prices would change when my stock price goes from 50 to
Hmm.
51, or there is a 1 unit change, right? So just to show you, and let's make this clear. Let's say there are two tables, and I wanted to show you so that when you see this in the exam, you
Yeah.
would know what's going on here,
Yeah.
right? So when you see the strike price as 50, 1 second, let me see if there's a highlighter. Highlight, yes. Oh, it looks ugly. Never
Hmm.
mind. Cancel. Right. So for a strike price of 50, 52.5, 55, if I have to say what is the call price of June 50,
Okay.
so the language goes as the call price of June 50, right,
Yeah.
is 7.4.
Yeah.
ठीक है, तो अगर आपको ऐसा बोलना है, किसी को बताना है,
Yeah.
और आप कहना है तो कहना है जून 50 वाला 7.4 है,
Yeah.
right? So I can say for a May 55,
Yeah.
it is 4.0, right?
Yeah.
Now my point is that if my call price is 4.02, if my call price is 4.02, and I'm saying, what if the price goes up by $1?
Hmm. Hmm.
Look at this one. Delta measures a change in the price of an option for a 1 unit change in the price of the underlying. Assume, look at this one. All other factors held constant. This is the
Hmm.
most
Hmm.
important,
Hmm.
right? So we assume that everything is constant, then we are looking at it. And if I say that, let's say my stock price is 52.14,
Yeah.
and if I just increase it by 1,
Yeah.
right, for a strike price of 55, same, May 55, and if the option price 4.02, if I increase this price by $1,
Yeah.
for a same strike price for a same month, my option price would increase by 4.02 plus 0.47.
Got it.
My new call price would then be how much is this?
0.49.
4.49.
Yeah.
Make sense? Are you okay with this?
Yeah.
And as I said clearly, assuming I'm saying that the strike price is still 55, right? I'm just saying if the stock price is 52.15, how about my option price would change for the same strike price, same month,
Hmm.
right? I'm just ensure to understand that I'm not adding 6.26 to 0.47. Apples to apples comparison. So for a
Sorry.
strike
Sorry.
price of
What? What?
55, right? You had a question.
No. What did you say? That the 52.5 and 55?
I'm saying for a strike price of 55,
Ha.
when you are adding the delta,
Yeah.
ensure that you are adding the delta of the same strike price.
Ha. It's not. Yeah.
Should not be the case that for a strike price of 55, the option price is
Yeah.
4.02 and you add 0.623. That's not the case.
Yeah.
For a 4.02, you should add 0.47
Yeah.
because it is of the same strike price.
Yeah.
There's one more thing that they mentioned, and I can also create this graph. But the idea here is that they're trying to say is that can you see? Acha, before we proceed, I just want to tell you the limits of delta. So the delta actually goes from 0 to 1
Mm-hmm.
for a call option,
Mm-hmm. Mm-hmm.
and it goes from 0 to -1 for a put
Mm-hmm.
option. So from out of the money to in the money,
Mm-hmm.
you would see a delta of this, and obviously the curve is not a straight line.
Yeah.
And for a
Yeah.
put option, you see something like this.
I see.
But
And y-axis is the delta and x-axis is the stock price, right?
yeah,
And this curve, like for the call option going up like that, that is as the strike price gets closer to the as the stock price gets closer to the strike, is it?
correct. The strike
Yeah.
price, yes.
Okay.
Yes. And the point I'm trying to make is that although we see and we know that for a put option it goes from 0 to -1 and for call option goes from 0 to 1,
Yeah.
in the book and in a lot of places they use the word absolute delta,
Okay. Got it.
and then
So
they say
basically for
that,
call and put, they say the same thing. Is it?
correct. So they say that for in the money option ITM, the delta goes from 0 to 1.
Okay.
So for from OTM to ITM, the option goes from 0 to 1
Hmm.
for both call and put. But in reality, you know that it goes from 0 to -1, this is from 0 to 1.
Yeah. Okay.
Right? But you will see a lot of places where it just says that it goes from 0 to 1.
Got it.
All right. So this is delta, and let's talk about gamma. Whatever I said for delta, that change in 1 unit of a stock price,
Mm-hmm.
basically change in the option per 1 unit change in the stock price, right?
Yeah.
Just replace option with delta and the stock price with option. Basically, it's a one level up,
Mm-hmm.
right? So the gamma says that it is, we say that what the change in the option price per 1 unit change in the stock price. The gamma says it is a change in the delta per
Mm.
1 unit change in the stock price.
Got it.
So it's kind of a what we say is double derivative,
Yeah.
right? We used to do it in a d by dx in engineering at
Yeah.
least. We
Yeah.
do a d of d by dx,
Yeah.
right? So just to put it normally, that while the delta looks at the option call and put price per stock price, the gamma looks at data. So that's a slope of gamma is actually the slope of the delta,
Yeah. Correct.
while the delta is the slope of the option,
Yeah.
right? Again, obviously in CFA they are not going to go into technical terms as in the how it is slope and how it is calculated, right?
Mm-hmm.
But the idea is that gamma is kind of a double derivative which looks at the delta and not at the option. So when you look at change in the option, you will not be
Yeah.
able to see directly what's going on with the gamma, but
Yeah.
the change in delta will tell you what's going on with the gamma,
Got it.
right? One thing that you always need to remember is, and gamma is a little tricky to understand how it actually behaves, but one thing that is tested in the exam and you should know that gamma is at its peak when the option is ATM.
Gamma is at its peak.
When the option is ATM, which means the maximum value of gamma can be achieved when the option is at the money.
Okay.
Right? This is an important result to remember, because how you can get the questions in the exam is that they will give you a whole situation.
Yeah. But I thought gamma will be zero there, no? Like, so suppose if I think about a call option, and if you just drew that curve, it is plateauing as it is getting closer to the strike price. So the rate of change over there would just be zero, right? As you're plateauing.
Yeah, but then the change of delta at ATM would be maximum, right?
Change of delta would be maximum, correct? Yeah, yeah.
Right. So, and then the gamma is the change of the delta.
Yeah, yeah, yeah.
Right. So the gamma will be maximum at ATM.
Okay, got it.
So what I'm saying is that you will get questions where they give you so much information and it
Yeah,
sounds like that you will have to calculate something,
yeah,
but
yeah,
actually you don't have to.
yeah,
Right. So what I'm saying is they give you so much information that he bought this, he bought that, and then he has options of this, he has options of that, then he put a gamma, then he put a delta, and this and that. So which of thing is most appropriate in this?
yeah,
Right. So what I'm saying is, just when you look at the options,
yeah.
don't go into details of what the numbers are and what do you have to calculate. Just focus on what is the strike
Mhm.
price, right? What is the strike price? And when you see an option that has a value matched with the strike price, which means it is at the money,
Yes,
that option will be the correct option.
that option will have the highest gamma, basically.
Yeah, which means that will be the correct option to choose in the exam.
Got it.
So what I'm trying to say by this is that they trick you by giving you a lot of information,
Mhm.
but they only want to test this point whether you know this or not.
Ah, got it. Got it.
So sometimes when I was studying my CFA level 3,
Hmm.
right? So sometimes I used to get scared with this delta, gamma, vega, and
Yeah,
then it
yeah,
looks very complicated, right? When they
yeah,
give you so many numbers. But
yeah,
then while doing the question, and when I was attempting it at home, practice books, so
yeah.
most of the times I used to do it wrong,
Hmm.
right? But then when I looked at the solution, I realized that okay, I actually didn't have to do anything over here.
Hmm. Hmm.
No addition, no subtraction, nothing. कुछ करना ही नहीं था उसमें.
Hmm.
बस समझना था कि करना क्या है और वो चाहता क्या है. तो they were trying to test a point here that okay, do
Hmm.
you know that it is maximum at ATM, and if you know this, you will be
Hmm.
able to solve the question in 30 seconds.
Yeah.
Again, as I said, in terms of absolute terms, you should always remember the more the ITM, higher the delta.
Yes.
Absolute terms. The more the OTM, the lower the delta.
Yeah.
And since I'm using the word absolute, so it means this is closer to 1, this is closer
Yeah.
to 0. Are we good?
Yeah.
There's one more thing that they can give you some strategies, and I'll tell you something more about on how you look at things. Um, all right. So you have studied forwards and futures, right?
Yeah.
So people give you answers and then give you theory. I'm giving you a theory and then we'll tell you the conclusion. When you invest in forward, what does that mean? It means first, you will have to execute.
Yeah.
But second, no matter where the market moves, your price is fixed.
Yeah.
And I hope you still are of the same opinion that in forwards and futures, these are not options.
Yes.
You will have to execute and you will see the payout as profit or loss. You cannot get away with it.
Yeah.
Right? But no matter where the market moves, you will
Yeah.
still end up paying the same amount, which is fixed.
Yeah.
Is that correct?
Yeah.
So what I'm trying to say is that, and can you say that the delta is the change in the option
Yeah.
per unit change in stock price,
Yeah.
right? And if I'm saying that in a forward contract, when you go long and short, etc., you effectively, irrespective of where the market moves, your price is fixed. It means that your delta is zero.
Yes. 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 Yeah.
You agree?
Agreed.
Okay. So this was a theory, and this is the result. So you should remember, and then you will see, and I'll make you solve a few questions also. The important result to understand is that when you are the delta of a long position is +1.
Yeah.
And the delta of a short position is -1.
This is for what? This is, but we just spoke that future, the delta is 0.
No, so this is how it works, right? Let's say let's say you are long a contract.
Oh yeah, it's always +1. Basically, it
Exactly.
increases. It increases by 1 as it gets. Yeah, clear.
Exactly. But then to offset, you are short a contract.
Okay.
That's how you offset your position, right?
Yeah.
That's how you offset your position.
Offset.
So
Yeah.
effectively, that's how when you are long a stock and then you take a for short, or basically you sell a forward,
Yeah.
you are long a stock, or maybe you're long underlying. Let's not use the word stock, but you are long underlying,
Yeah.
right? And then you take a short, then you sold a forward.
Yeah.
What does
Yeah.
that mean? Think about the scenarios, right? Where they say that you are going to receive 1,000 euro after 1 month. You're going to receive 1,000 euros after 1 month, but you know that FX rate would change. So you actually sold a forward for 1 month expiry for this exchange, whatever, right? So ultimately you are long underlying and then you take a forward position in the opposite way. Basically, if you're long, you take a short position, and
Yeah.
that's how you fix your price, right?
Yeah.
If it is difficult to understand, let me know. I can give you more examples. And if you're clear, then it's okay.
Now this last part, so basically your short thing. So your delta is 0 basically. That's what you're telling.
Yeah. But no, but not just buy short. Let me tell you.
Huh.
Think about CFA level 1,
Huh.
where they initiated a discussion on forwards and futures.
Yeah.
And they say that, okay, if I want to buy potatoes
Yeah.
at the rate 100 rupees per kg,
Yeah.
and I want to lock in my price,
Yeah.
I can buy a forward.
Correct.
Buy a forward today for 3 months.
Correct.
Which means no matter what happens to the price, whether it is 90 or 125, you will end up buying at 100.
Yeah.
So this is for a standard long position only,
Yeah.
right? Where the delta is +1.
Yeah.
Just a long position.
Yeah.
Now, what I'm saying is, you already own a stock worth rupees 100.
Yeah.
Now, you are scared that the price might go plus or minus, right? So you actually sold a contract, or sold a forward at the rate, let's say 100.
Yeah.
So in that case, think about this. So if the price goes up, you make money,
Yeah.
but you are short a position, so you will make a
Yeah.
loss.
Right.
If the price goes down, you will make a loss,
Yes.
but you're short a position, so you will make money.
Yes.
Ultimately, you will end up locking at this price. Do you agree?
Yes.
So far, so good?
Yeah.
So can you say that by taking the offsetting position, you locked in your price, and no matter where the market would move, you will end
Yeah.
up paying the same amount?
Yeah.
It means you have no impact of the market volatility.
Yes. Correct.
It means no matter where the price moves, it doesn't change your overall outcome
Correct.
or results,
Correct.
right? Now, just covering the whole thing under delta, and it is easy to say, and it is intuitive to say from this, that from owning a stock when you were long a stock, your
Uh-huh.
delta was +1.
+1. Yeah.
When you sold a contract, your delta was effectively -1,
Yes.
right? And hence your delta in this case will be equal to 0. And that's how it is implied that no matter where the market moves,
Yeah.
your value doesn't change. It
Very
just
clear.
satisfies the condition.
Yeah. Very clear. Yeah.
Yeah. So just remember that when it comes to delta, you might get a few questions, and then we'll also try to do one question
Yeah.
that in case you have a long position, then your delta would be positive, and when you have a short position, your delta would be negative.
Yeah.
And then depending upon how many contracts are you buying and how many shares do you have,
Yeah.
accordingly you can multiply those delta and calculate the final delta, either 0 or something else.
Yeah. Clear.
Perfect. There's one more statement, and then let's just validate if we are okay with this, so that in case we get any questions in the future, we would know. Can you just read this professor's note, although we covered this already, or maybe for example, or maybe from overall? Just read from here.
Yeah. The overall or portfolio delta for a combination of options and positions in the underlying is computed by adding up the individual deltas, being careful with the signs. For example, a holding of 100 shares in XYZ will have a delta of 100 into 1
Hold on, hold
minus.
on, hold on, hold on. So holding 100 shares basically means you're long.
Yeah, you're long. Correct.
Okay, so your delta would be 100 shares multiplied +1 because you're long.
Yeah,
So
yeah, makes
100
sense.
delta. So the price increased by $1, the position will increase by $100. You
Super,
agree on
yeah.
this? Okay, perfect.
Makes sense.
Now let's look at the professor's note.
That is, if the stock price rises by $1, then the position will rise. Professor's note. Unless told otherwise, assume that a traded stock option contract is a right over 100 shares. So long position in XYZ call option contract where the option delta is 0.65 would have a position delta of 100 into 0.65, which is 65.
Does it make sense?
Yeah, makes sense.
Okay.
A holding of 1,000 shares in XYZ plus a long position in 10 XYZ put contracts, delta is equal to minus 0.6, has a position of 1,000 into 1 plus 10 into 100 into minus 0.6. Why is this happening over here? Because you have 10 put contracts. Shouldn't it just be 10 into minus 0.6? Or why is it not that?
Yeah, it is 10 to minus 0.6, but then it says that the contract has a right over 100 shares. Look at this line.
Ah, okay.
Right, so when it comes to 1,000 shares, you have 1,000 into 1, which you are long
Oh,
the delta.
okay.
But when you have a put plus a long position, delta equal to this.
Yeah, clear.
Put contracts ले रहे हो, right? You're buying a put contracts.
Yeah,
Yeah, delta of -6. So
yeah,
this is going to be over, and then you are long. So you're adding.
yeah,
Right? When you're longer position, you are adding.
yeah,
So again, 10 into 100 because it's of 100 shares, multiply the delta. So effectively, you will have overall 400.
yeah,
So they say that the stock price falls by $1, the
yeah,
shares will lose by 1,000.
yeah.
But using the overall position, your overall position will only fall by 400.
Hmm. Hmm.
And that's the whole objective of buying a the put contract, right?
If the stock price falls by $1, then the shares lose 1,000.
Obviously, so assume that you don't have any option over there.
Yeah,
So
yeah.
So the value will fall by $1,000, right?
Yeah, but the value of your put option will increase, is it? That's
Yeah. So you also have a put option. So think about this, right? The put option will allow you to not make so much loss,
yeah, that I got. Yeah. But
right? So
how
the
do you,
overall
but
value will fall by only $400.
the put is priced at one, is it? Like, I mean, every fall in $1 results in 0.6 of the price
Yes,
of the put increasing. Got it.
yes. So the price, if the price will fall by $1,
Yeah. Makes sense.
that's right.
Yeah.
Okay.
Yeah.
Sure. Are you comfortable with these things?
Yeah, yeah, comfortable.
And then something that we already discussed, but just wanted to show you. And they use the word protective put pre-expiry, and then they said covered call pre-expiry. The only thing that they're trying to mention over here is that we usually assume that whatever transaction that we would do at expiration, right? At ST,
Yeah,
right? But assume that we are of the opinion that I'm going to make a loss for sure.
yeah,
Then why to hold till maturity?
correct, correct.
Let's take a offset position pre-expiry, so that
Yeah.
at the expiry, the thing about this, the whole idea of forwards and futures and derivatives in CFA level 1, all they say is that if I know, if this is my timeline,
Mm-hmm.
if t equal to 0 and if t equal to t, when I think that the price is currently here, it was 100,
Yeah,
we took a forward position for 110
yeah,
for future, but it is already 108 at this place. And if I'm obviously, if I'm at a shorter end, basically if I have to give and someone is long, so I know that I'm going to make a loss,
yeah,
right? And I know that by the end of this it could be 120,
yeah,
right? So I assume that the person who is long the contract, he's going to execute at 110,
yeah,
and I believe that the price might go up to 120 or maybe
yeah,
more. So
yeah,
I would effectively not wait for it to go expiry.
yeah,
I'll just, if I'm short a contract, I'll buy a contract. Basically, I will be a longer contract if this is 6 months, right? And this is 4 months, and this is 2 months.
mm-hmm.
Then I'll buy a longer contract for 2 months.
Yeah.
So effectively, I have locked in the price today itself for
Hmm,
this.
hmm, 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 hmm.
Now, no matter whether it is 120 or 130 or whatsoever,
Yes,
I have made whatever losses that I'm going to make, because
you have locked
let's say the
in.
current price is 108.
Yeah, yeah,
So I've locked in my price for 8 rupees. 8 rupees.
yeah,
Although I will be selling at 110 and maybe
yeah,
the market will 130. But you understand, right? Everything that I'm going to do is going to offset
yeah,
for this period. And I have locked in my price for 108, which is just this.
yeah. Makes sense.
Right? So this is what they talk about in the last paragraph. When you will read, you will understand. So they say that overall, the long of the delta of the long stock plus the delta of the short position, since we are offsetting completely, so the overall delta would be 0.
Oh, okay, okay. Yeah, yeah, makes sense.
So that's how we have hedged our price movements.
The overall delta will be zero.
Something that we just,
You know,
just
I understand in theory that because it's not affected by market pricing, you'll be at zero. Yeah,
right.
right. Okay, yeah, makes sense.
But does it make sense to you as well?
Yeah, yeah. Theoretically, it makes sense. But the delta of the call option that I had sold, that will be different from the delta when I buy the call option to limit my loss. So
True, but then
mathematically,
no,
huh?
no. But you're mixing two things. I'm not, for call and put options. The deltas are different. They are working as it is. We are not trying to offset. I'm telling
Okay.
you a position where you are long underlying and then you buy, basically short a forward contract. So this delta is more in line with longer position and shorter contract, or vice versa.
Okay. Okay. And then, but the call option that you're shorting, that delta won't be like -1, right?
The call option that you are shorting.
Yeah.
So if you're long a call, the delta will be, again, it depends on whether it is ATM or OTM or ITM,
Yeah.
right? But
Then
then the point is that,
mathematically, how does it get to zero? Like, I understand theoretically that it's not affected by price of the market.
so on those cases, it will not be, never be zero.
Okay, got it.
So for call, think about this.
No, no, I understood. So it won't be zero.
Yeah, so for call and put options, the delta will not be equal to zero.
Yeah.
You will not be
Yeah.
able to offset the two positions,
Yes, yes.
right? Because the premiums are different and the way
Premiums
the
are-
market moves will be different,
Yeah.
right? If the market is going up, then that if the delta for a call option improves or increases from 0.5 to 0.75,
Yeah.
and if the prices goes one down, right, the call delta will not increase similarly,
Yeah.
right? Hence the delta will not be equal to zero. So
Yeah.
I'm saying this, there is no way that you can offset call and put options,
Got it.
and hence the delta cannot be zero.
Got it.
However, when you are long a position and you sold a forward, in this case the delta could be zero,
Yes.
right? And also you can this is what I was saying initially, that will delta be zero or not zero, more than calculation, you can understand whether you
Yeah.
will be able to hedge it completely or not.
Yeah. Yeah. Got it. Got it.
Since you can hedge this part completely, you can confidently say that the delta could be zero. But can you
Got it.
hedge call and put completely? No.
No, you can't. Yeah.
Make sense? All right.
Yeah.
Let's try this question. And the spreads will come in some time. Theta and Vega will come in some time. Okay, we were here, right? Position deltas covered. Protective put pre-expiry. Covered call pre-expiry. Okay. Let's just try this question.
Hello.
Hello? Yeah, can you hear me?
Yeah. Yeah.
Yeah. I
Question
want
number.
to try this question. This one.
Yeah.
Yeah.
Which of the following would most likely be possible deltas for covered call and a protective put position just after they were established with 3 months to expiration? So, covered call, basically, you short a call, so you have negative delta, and you have an underlying, so you have +1. Protective put position, you're again negative delta, and um, you have +1 because you have the underlying. Put delta, the cover were established with 3 months to expiration. The covered call has a delta of 0.4 and the protective put has a delta of 5. Covered call has a delta of 0.35. So the option is option B. So that's the correct one because C, so both certainly don't have deltas of 0. Option C is not possible because the protective put can't have it at -0.4 because Like the put is the delta of a put is between 0 to 1,
Okay.
and you have the underlying at 1, so can't be negative.
Okay, perfect. So do you understand the point that I was trying to make, and I gave you this question to solve? It's more to do nothing to do with 0.4 versus 0.45 and
Yeah,
0.5.
yeah,
Even if they would have given 0.2 or 0.3, doesn't matter.
yeah,
So here we need to understand that if it is negative or positive or zero, but doesn't really matter if it is 0.4 or 0.45.
yeah. You need to understand if it's negative. Yeah, yeah, correct.
Correct. Okay, perfect. Now let's proceed. Now there are two more Greeks left, which is theta and vega. All right. So
Mhm.
theta is basically, you can say that it is more on time, right?
Mm.
So it just tells you how my option loses value as time passes. Now think about this. Even if you buy the option right away and you have 3 months to expiration,
Yeah.
right? In terms of theta, you are losing the value of the option the next moment it is less worth than now.
Yeah. Yeah.
So in terms of theta, at least in terms of theta, you are the option is always losing because the
Mm.
time is lapsing.
Mm. Mm.
Again, I'm not saying that the option value increase or decrease. I'm saying everything else constant just in terms of theta.
Mm.
I can't really translate that okay, my option value is going to increase or decrease because everything has a small proportion and some things have higher weightage, right?
Mm.
Higher weightage as in the delta would be higher when there's a change in the price. But
Yeah.
I'm saying in terms of theta independently, the option is losing value as the time passes. So the theta will always be negative.
Yeah, and it would be the same for options that have different strike prices but same expiration, or no?
Different strike price, let's say 55
Yeah,
versus 58, but
yeah.
what same?
Expiry is the same.
Okay, okay. If it is for 3 months, so you start from here, independent of 55 versus 58, this theta is only looking at this 3 months.
Yeah, got it. Got it.
So I'm saying obviously when they are close enough, the strike price could be the value of the theta could be little bit same here or there. But I'm saying you will not see much change in the theta, whether it is 55 or 50.
Okay, got it.
Not much change. But yes, you will see a huge change when the expiry is January versus
Yeah,
February versus March.
yeah.
Right? So I'm saying I'm not talking about at a fourth decimal place or fifth decimal place. It could be a little bit here or there because of so many factors. I can say that if the theta is minus 0.5, let's say, so it
Yeah.
could be 0.501 for this, or maybe 0.5005 or something
Mm.
for this, just in case I'm just giving some random values. But it is going to be very different when the expression would be different.
Yeah.
So you can say closely that theta is same for different strike prices, but for different time horizons, it is very, very different.
Mm.
And the most important thing is always be negative.
Sorry, always what?
always be negative. The theta value will
Yeah.
always be negative.
Mm.
Again, something that could be tested in the exam, and you should
Yeah.
know, right? So if there is an option where you have a theta is positive, straight away strike it off that it cannot be an option
Yeah.
ever.
Yeah.
No matter what the strike price is, no matter what the option is.
Yeah.
So you will see for a theta, the curve is downwards. Okay, and this is time value. This is number of days of expiry.
Yeah. Got it.
The last one that we have is
Wake up.
yeah. Vega is basically volatility.
Got it.
And Vega, you can say that it is always positive.
Mm.
Right? Now you can say that it is either you can say it is less volatile or it is more volatile.
Mm.
But you can't say that it is not volatile or not negative, because think about this: if the stock price is 50,
Mm-hmm.
even if it goes to 45 or 55 or 49 or 51, so either the volatility is low or the volatility is high, but you can't say that there is no volatility.
Yeah.
I'm saying that way the Vega is always positive.
Yeah.
And how about Vega in terms of number of days? So
That
basically,
it doesn't matter, right?
okay, think about
Or
this.
is it absolute volatility? So like no, I don't know.
No, it is nothing to do with absolute because it's always positive.
Yeah. Got it.
If it is positive, I don't have to do an absolute of that. But what I'm saying is, let's say I bought two call options, right? One today is what? Let's say
No, by
June.
absolute I meant basically volatility for 5 days is higher than volatility for 1 day. Is that how?
Oh yes, totally. So this is what I'm about to say. That for a 1st June, if you have a 3 months option
Mm.
versus on 1st June, if you have 2 months option,
Mm-hmm.
which one has more Vega?
The 3 month one.
The 3 month has more Vega, and why?
It has more days to expire.
Totally. Since it has more days to expiry, the chances of movement of the stocks is more.
Yeah.
The stock could go either way.
Yeah.
Versus for a short day, think about this, right? You have NBCC today at 100.
Yeah.
In one day, how far could it go? Maybe
Yeah.
110, maybe 90. But in 30 days, it can actually move up to 200 or maybe 40.
Yeah.
So for more number of days to expiry, the Vega is more. For less, it is less.
Yeah.
Okay. One more thing, when it comes to calculation, so you understand that volatility is kind of a risk, right?
Yeah.
And which is around, we can say something similar to very sigma.
Yeah.
So you must have studied in your CFA level 2.
Yeah. Standard deviation.
Somewhere, exactly, so somewhere in terms of portfolio management, etc. Right? So if I say that you are looking at 2 months volatility is, let's say, 50%, right?
Yeah.
So when you say 2 months and you're trying to calculate for maybe when you say 2 months and you're trying to calculate for, by the way, do you know that when they say 50% 2 month, it is not 50% for 2 months, but for annual number?
Okay, got it. I didn't know that.
Okay, so basically what they say is anything that they say, let's say they say that 3 month rate, and this is the normal. I mean, I think 95% of the people make this mistake in level 3. I have taken classes before for level 3, and even though they clear level 1, level 2, they have this doubt. And I said, how did you clear fixed income? Right? When they say 3 months rate is
Yeah,
4%,
analyzed.
this is always annualized.
Yeah,
Always.
can be that 4% for 3 months. Yeah.
Exactly. Exactly. So I'm saying that they might confuse you, tell you that 3 months rate is 2%.
Hmm.
It's still this is annualized number, and you have to do 2 multiply 3 divided by this.
Yeah.
Always, right?
Yeah.
So I'm saying that similarly in terms of volatility, when they say that the volatility is something and you want to increase or decrease depending upon number of days,
Yeah.
then in that case, but ensure in other variables, in other terms, we just multiply like 3 by 12, etc.
Yeah.
Right?
Here you have to
But
take the square root.
absolutely, that's about it.
So you do square root of 50% into 2 by 12, is it?
Yeah. So no. So 50% is the number which is as it
Oh,
is, and square root of the number of days that you're using.
okay.
Right? Let's just look at this so that we are sure that what we know
Hmm.
is what we have understood.
Hmm.
Let's just read this. In converting between volatility, which is standard deviation values for different time periods, we multiply the volatility number by the square root of the ratio between the period lengths. Make
Yeah.
sense? Okay. For example, if we have used a pricing model to compute an annualized implied volatility of 57% from the value of an option expiring 2 months,
Yeah.
let's say 2 trading days, then assuming 252 days trading year, we derive an expected 2 months volatility. Again, look at this.
Hmm.
They say annualized volatility of 57%,
Yeah.
and then they say the 2 months volatility is 57
Yeah.
multiply 42 number of trading days divide by 252.
Yeah.
Again, the other way around, if they say, it will be the opposite. But the only thing is that all you need to do it as a square root of something always.
Yeah. Awesome.
Here,
Clear.
good so far.
Yep.
Let's do one more topic and then we'll wrap up today's session.
Yeah.
Something called as calendar spread.
Okay.
First of all, the name clearly explains that you are creating a spread,
Hmm.
right? And then the name calendar, this is not written in the book, but I'm saying from the word calendar, we can say, okay, something with respect to time.
Yeah.
So you are again buying and selling options. So basically you're trying to earn using the spread,
Yeah.
but you are using time. Time as in you will have different expiration.
Hmm.
Right?
Hmm.
Since we know all the concepts regarding this, let's just quickly look at the question and understand what's going on.
Yeah.
One second. Yeah. So it says, suppose that on March 20th,
Yeah.
when the XYZ stock price is 52.41, Jenkins has a long-term bullish view on XYZ stock price,
Yeah.
but that over the next month he anticipates a very little movement.
Yeah.
Okay, what does it tell you?
It says that volatility is low.
Okay, understood. Yeah. So for the next one, the volatility is low, and
But
but the long term is,
he still expects the price to go up slightly.
yeah, totally right. So what he does is, so he buys 4 XYZ June 52.5. So can you
Okay.
see that it is very close to the stock price?
It's yes, yes.
So he buys,
Yeah.
and then he sells for 52.5 for 3.53. Now, what did he do?
He sells a call and buys a call. Same
He
price.
buys the call. Can you see here? He buys 4 XYZ June expiry,
Okay,
and he
okay.
sells for April expiry.
Okay. Hmm.
Why is he doing a long-term June? Why is he long on a June call? Because his long-term view is bullish.
Yeah,
When my long-term view is bullish,
yeah,
then I will try to buy a call option for the long term.
yeah,
But since I think that there is a very little price movement, which means the price will not move much, so selling a
yeah,
call will give me some extra money, and I know that it will never be called.
yeah,
But that's my anticipation.
yeah.
Does it make sense?
Makes sense.
So effectively, as I said, it's a spread. Remember this. He doesn't own anything.
But what is the spread that he's trying to pocket over here? Is because he's he's paid 6.22.
Okay. So let's look at this one. Don't think about that he sold anything. Think about
Okay.
his view is bullish on the stock,
Yeah,
so he's going long.
yeah.
So basically, he just bought 4
Okay.
XYZ long for this much amount, and he
So
should have paid.
he's yeah, okay.
But then
He
I'm
should
saying
have paid. Oh, got it. So he's effectively reducing his cost. That's what he's doing.
exactly. So effectively, he should have only bought at
Ha
6.22.
ha ha.
Let's say only one. So she should have paid only 6.22, and that's
Ha
about it because
ha ha.
his term is bullish. But
Yes. He
just
has
because
an
he
extra view.
knows,
He has that
yeah,
extra
just
view
because he
that
knows that the price movement will not be much in the next month,
yeah,
he actually sold the call for this much amount. So his
yeah,
premium that he paid will become little lesser,
yeah,
right? But why I'm calling it, so we understand the part spread here, but why I'm
yeah,
calling it as a long calendar spread is because he actually do the two transactions, but the expiry date is different. Can you see?
yeah.
So he is
Understood.
long on June, but he is short on April. Does it make sense?
Makes sense.
Now, let's say in April, the price will still be 52.4.
Yeah, yeah.
In that case, his profit is whatever he has saved because
Yes,
that option will expire out of the money.
yes. Yeah,
If at the April call expire, the stock price still 52.14,
yeah,
both calls will be OTM. Okay, I'm still okay with my long call with that because
yeah.
that's for June. I don't mind.
Yeah, that's for June. Correct.
Right? But the April call will expire worthless, and I'm happy. I just got the money, but I didn't have
Mm,
to do it. Right? Now, assuming all the factors are unchanged, the June call will now be worth 5 rupees. Again, leave that part. Okay. The reason
mm.
why they're saying is that we were looking from March, the price is 6.22. But you can imagine that when it comes to April, the call premium would be a little lesser. Why?
Yeah,
Because the
because
time to
it's
expire is
closer
now
to
less,
yeah,
right? Because Theta would do its job and the Vega bits do its job. So we know that since the time to expiry is now less, so it is going to worth little less.
Yeah.
Right now, think about this. If he had to buy it then, let's say in April,
Yeah.
he should have paid 5 into 400, 4 units of this per 100.
Yeah.
2000. Assuming that he hasn't done any of these things before.
Jenkins will now have a position worth 5 into 400. How did this come about?
No. I'm saying that's when he comes, think about this, he's in April right now.
Yeah. Okay, got it. No,
He's in
clear.
April right now, and the worth of the
Yeah.
option is
It's worth
$5.
$5. Yeah.
Exactly. So the worth of his position is $2,000, but
Yes.
effectively he only paid 1076.
Yes.
Right?
Yes.
So I'm saying that even if he offsets everything, even if he just sell everything right away,
Oh, yeah, he would
he
make
can
money.
still make $1,000
Yeah.
without doing anything.
Very clear. Yeah.
Make sense?
Makes sense.
Okay, perfect. One more thing that I want to reiterate before we wrap up is the last 2 bullet points. That's about it. Look at this one. A long calendar spread will benefit from a stable market or increase in the implied volatility. Let's look at this. How did we earn from a stable market? We saw that in April,
we
the
did
movement
that.
was very less.
Yeah.
So that's how we sell the option and we earn the money.
Yeah.
And for a long term, when the implied volatility is higher, so because I'm long option for a longer duration, so if the volatility is higher, the value of the option would be higher.
Yeah.
And this obviously is the opposite of that.
Yeah.
Make sense?
Got it.
Okay. So tomorrow, we'll start with volatility skew and smile.
Yes.
We'll do a couple of questions and then we'll move to swaps.
Okay. Thanks so much.
No worries. I hope you're getting derivatives better than before.
Yeah, much better. I think I'll just have to sit today and just reflect on whatever we did, and then I think it should be good. But it's making a lot of sense. I think fairly.
Great.
Yeah.
Great. And even if you don't get time today, at least after tomorrow's session, then you can spend some time over the weekend.
Of course. And I'll review and you suggest I do some questions and all also?
Yeah, obviously. I mean, you can try some questions on your own. And I have also planned a test for you, but then this is towards the end.
Perfect.
I'm also thinking that I'll give you rather than we both be on the call, I'll give you a test. And then you being honest, you try those questions at home without looking at answers, etc. anywhere.
Yeah.
Done. Then we can discuss it in the next meeting. But this has been scheduled over the end of the session.
Okay. Perfect. Awesome. In terms of practice tests, the overall test, you do any resources? Because these people who I got the curriculum books from, they didn't have tests, and I know that usually Schwezer Kaplan has tests. So I'll just get it from Kaplan. You said you think so?
Yeah, to be honest, when I studied from Kaplan mostly.
Yeah.
The book that I'm referring to.
Yeah.
I did do a few questions from curriculum that you have.
Yeah.
Obviously, they are very lengthy, so I couldn't complete all, to be honest.
No, that is fine. See, because I'll tell you why. I level 1 and level 2, I had given at least 7-8 tests before I gave the actual test when I was actually preparing properly, and that really helped me.
Absolutely, it does.
Yeah,
it does.
So I was in test mode. So even though I may not have covered the entire portion, because level 2, I remember I'd come back, I didn't have much time, but because I was just so test oriented, it helped. So post our entire thing as well, I want to just then give tests for the last 2-3 weeks.
I totally agree with you. I'm saying that I don't know if they're timed or not, but do they have some practice tests on CFA website?
They, I think, do. I think they have 1 or 2 tests, so that I will do for sure.
Yeah.
And then maybe Kaplan, I'll check with
Kaplan. Yeah. But let me also tell you, when I wrote my CFA level 3 in 2018,
Yeah.
At that time, they had practice book volume 1 and volume 2 because it was not a proctor-based exam at that time.
Okay.
So
Okay.
even both books
Okay.
have five tests. So even whatever you're saying, I did the same, right?
Ah,
In last 2 weeks, I solved every test one day and then look at my
understood.
incorrect answers the next
Understood.
day, right?
Understood.
But I just checked with Shrezer a week before, and they
Hmm.
don't publish. Basically, Kaplan don't publish any practice books anymore.
Oh, okay.
Right. So yeah. So the only test that you might have is either practice. I mean the Shrezer books, or the curriculum, or the website.
Oh my God. Why did they? Okay, makes sense. Okay, perfect.
Right. All right. Then I'll just see you tomorrow, and then we'll take it from there.
Yeah, awesome. Thank you.